Let's see, so Vince is looking at. Hey Vince, how's it going?
Hey, what's up, bro?
What's up, man? Oh yeah, so I saw the video you sent. So this is for the K2 momentum pullback strategy. So it's kind of similar to what we've been going over, but it's just a little different. So I'll show you kind of how it works.
My fault, bro. I had got confused with the name. I just remember I saw something like that when I was looking at the lessons.
Oh yeah, no, that one's pretty good too. I used to like using that before, like when the market's moving, in one direction. But since the market was kind of bouncing back and forth, I kind of stopped using that for a while. But we were using that a lot like last year during the summer, and it was like hitting like back to back. But
Okay.
I can go over it with you right now. It's a simple strategy as well. So basically, the way that she used that strategy, I'll put the requirements right here. So this is going to be the K2 momentum pullback strategy.
Let me see if I remember. It has to be like 10 below the what was it? The K2, was it the SR? The green line. I just know about the colors.
Oh yeah, no. So like, so basically, when we're applying the normal strategy, we kind of want to match the colors. Like you kind of want to have green and green, and then you take your buy like right here. But the difference with the other strategy is we're doing the opposite. So instead of trying to match them, we're trying to look for something that's opposite. So like right here, you can see that it's a red sell signal, but the trend is up, right? So
Yeah.
pretty much the way that this strategy works is since price is trending up like this, when we see an opposite signal, like when, because obviously the price is going up pretty heavily. So when we get an opposite signal, this is just indicating that price is just pulling back, like it's temporary, because obviously, if price goes the opposite way of the trend, one way or another, it's going to end up shooting back up. So basically, this is how it will work right here. Let me just get the, pull this over here. Yeah, are you trading US 30 on the 1 hour? Because it's kind of risky on the 1 hour with the.
Yeah. When should I be trading on? 30 minutes or?
I mean, it's really up to you. The only problems, so like because when you're trading on the 1 hour, your risk is going to be a lot higher. So I'll put the requirements right here for that strategy, and then we'll go over it.
Okay.
Because if you're trading on the 1 hour, you're kind of risking like 3,000 to 5,000 pips. Versus when we're trading on the 10-minute, we're only risking like 1,500 pips. So there's nothing wrong with you trading on the 1 hour. The only problem, like, the bigger scheme of things is that you're going to be risking a lot more money. So depending on if you have a big enough account, it's perfectly fine if you got enough to handle the risk. But the thing is, if you're trading on a smaller account, like say under $1,000, it's going to be risky because you might get margin called out of the trade. I'm not sure if that's happened to you before.
Yeah, I think it's happened once before.
Yeah, usually if you don't have enough money in the account, and then you go too far in the negative, like more than half of your account, they usually just kick you out of the trade. So when you're trading on the higher time frames, you kind of need a lot more money just to have a little cushion for when it does go negative on you. But I'll show you the strategy right here. So basically, first you're gonna identify the trend using the K2 trend meter. And then next you're going to identify a valid K2 signal. And then lastly, you're going to confirm the signal. Actually, let me just change this right here. Identify a valid opposite K2 signal. And then third, enter on the low high of the candle. And I think that's about it. So after that, you're gonna put your stop loss at the previous swing. All right, cool. So this is pretty much the requirements right here. I'll show you two examples because there's another example here that didn't actually fill. So let's go to this one first so I can show you an example of when it doesn't fill.
Okay.
So basically, first you want to identify the trend. So using the trend meter down here, if it's green, obviously price is trending up. If it's red, price is trending down. Let me just delete this. But yeah, basically like right here, you can see the trend meter is red, so it's coming down. And then over here, the trend meter is green, so it's obviously going up. So first, you just want to identify the trend by looking at the trend meter. So right here, you can see that the trend is trending up. And if you want to do it manually, you can also draw your own trend lines to confirm it. But it's pretty obvious down here if you just look on the bottom that it's trending up. So first, once you identify the trend, then you're going to have a bias. So since price is trending up, you're only going to be taking buy entries because obviously, if you don't want to take any sell entries because, if you're going against the trend, odds are it's probably going to swing back up even though it comes down. Because generally, if it's trending up, you'll see price go up and then it'll pull back a little bit and then it'll correct back upwards. And it just pretty much pulls back a little bit and then pretty much does the same thing over and over again. So that's kind of how this strategy works. So once you identify the trend and you can see that the trend is trending up down here, next you just want to identify a valid opposite K2 signal. So basically what you're doing is when you have the upwards trend, you're looking for a sell signal because it's going against the trend. And the reason we do that is because, like I mentioned earlier, so price goes up and then it'll pull back from time to time slightly, and then it corrects back upwards. Pretty much what's happening right here. So price comes up, comes down, and then it shoots back up. Same situation right here. Price comes down, it comes up, and then as it comes down right here, we're only seeing this as a temporary pullback, not like an actual reversal. So once you have these two requirements right here, like first you identify the trend, obviously price is trending up. Next, you identify a valid opposite K2 signal. So right here is a sell signal that's going against the trend. Once you have those two requirements, you can enter on the lower the high of the candle. So if you're entering a buy because the price is trending up, you're going to put a buy stop at the top of this candle right here. And then you put you'll put your stop loss at the previous swing, which would be somewhere around here. And this is what I was talking about earlier, because if you're trading on the 1 hour, you're going to be risking like, about close to 3,000 pips because these are standard lots. So you're going to add a 0 to the end of it. So technically, this is going to be a move for 2,850 pips. But since they're standard lots, you just got to take off the 0, and then that's how it looks like normally. So pretty much if you identify this, you can just set that trade and then you could just let it run. And if it doesn't fill for a couple hours, then price is probably not going to come up anytime soon. So you could probably wait for another entry. So right here, you can see price come down and it doesn't come back up at all. So in this situation right here, your trade never filled because the buy stop was up here on top of this point. So pretty much what you're doing is you're just having a pending order. And what you're trying to do is you're trying to catch price as it comes back up. Like how I was mentioning over here, like how it pulls back and then it shoots back up.
Yeah.
That's pretty much what we're waiting for right here. But it doesn't always happen. So if it doesn't happen, you just wait like a couple hours and then you're like, all right, it's been like 4 hours here. My trade hasn't filled. I'll just cancel it and I'll move on to the next one. So this one right here never would have filled. And then you would have just canceled it. So I'll show you the next entry over here, which is the same exact thing. So this wouldn't be an entry here because there's no trend. It's just blue right here. So you gotta wait for it to, you gotta wait for it to start trending again. So like right here, you can see it started to turn green. Yeah. So once that happens, you can start looking for entries again. So right here, you can see that price is going up because the trend is pushing up pretty heavy.
A quick question. You see how that that green, the sell signal was right before the trend turned green, like right before it.
Yeah.
You wouldn't take that trade, would you?
Me personally, I wouldn't take it because I want to be like extra careful. I mean, some people do take it because so if you want to use the trend meter down here, this is going to give you the trend on, the four different time frames that you set it on. So in
Okay.
order to get an overall trend, like it's going to be kind of hard unless the price is moving really smoothly. So the thing with US 30 is that the stock market kind of gets a little crazy, especially right now with the elections and stuff. So it's a little harder to find, an overall trend. Because if you go back, so if we go back in data like way back here, you can kind of see that like price was trending a lot more often, like around June and then like before COVID happened. So like right here in March, this is where COVID happened. But if you go to like beginning of the year, like January, you can see right here that it turns green like for a while, like from December up until January.
Oh man. All right. Okay.
You can see that it was trending nice because the market was moving normally. But then once we got to COVID, so like right here from December, you could literally take like all these buys, like how all these matched up right here, and you could have made like a ton of money off that. And then up until January, and then once it hit February, this is when the market started going a little crazy.
Yeah.
Like it was
All
trending a little, yeah, it was trending, but it was kind of going back and forth. Like it'd go from green to blue to, it wasn't steady like how it was over here. Like over here, you didn't even have to think about it. You could just take every buy and just pretty much write it up.
green,
But
blue, green, blue.
exactly. So like once we got closer to COVID, like I think this is when it started to be in the news, like mid-January. This is when it started switching up. So it was like green, blue, red, and it wasn't really smooth like how it was previously. Um, and that's why I recommend trading US 30 on the shorter time frames right now because you
Okay.
don't really know when when the market's going to go crazy like how it did a couple weeks ago where it just started dumping. So let me go to where we were over here. So yeah, like around this time it just started like the market just started getting a little crazy with these huge drops. But I mean, if you have enough in your account to handle these drops, then by all means you could run it if you want. But me personally, it's just a little too risky. So if you wanted to trade on the 1 hour and not use the trend meter, you can just use the pivots instead. Because so right here, you probably would have taken this trade because even though the trend meter is not green, it's still trending up on this specific time frame. Because for the trend meter, we have four different time frames. We got the 30-minute, 1 hour, 2 hour, and 4 hour. But
Okay.
on the pivots, you just have the specific time frame. So it just depends on how risky you want to be, or how accurate you want to be. Because there's a lot of trades here that you could have taken that could have probably played out. Like, so if we took off the trend meter, you probably could have taken this trade right here, and it would have hit pretty nice. And then you could have taken this one right here, and this would have hit as well. But you can see right here that you could have taken this one as well, but this one would have flopped. So it just
Yeah.
really depends on how risky you want to be. Because if you're trying to take a lot more risk, you can just focus on the individual time frame. But if you want to be extra careful, then you can use the trend meter down here.
Yeah. I'll probably use the 10 out the 10. You said the 10 minute, right?
Yeah, so if you go on the 10-minute, it's kind of easier for you to get in and out of the trade. So like right here, you could have just like, picked off all these little moves right here. So you could have picked off this move. Your stop loss would be right here for like 1,000 pips. So you would have hit that TP eventually. Same situation right here. You could have taken this trade right here and then your stop loss. And this is a huge difference. So on the 10-minute, you can see that the swings are only about like 1,000 pips, versus on the 1 hour, it's like a 3,000 pip swing. So you probably have to be like way down here.
Okay. All right. That makes a lot of sense now. I've
Yeah.
been doing time frame.
Yeah. It's just the difference with the assets. So if you're trading indices, they move a lot faster compared to Forex. So like with Forex, I trade on the 4 hour because it moves pretty slow compared to indices. But if you're trading indices on the higher time frame, it's just a little more riskier because you're going for these big moves and they could hit. Like there's nothing wrong with you taking the moves. It's just that you need to have enough capital in your account to be able to withstand those moves. Because a lot of people trade indices with like under $1,000, and like $1,000 is only gonna get you so far when you're trading like US 30 or Nasdaq or S&P. So I mean, yeah, it would just really depend on how you want to trade it because everyone trades differently. So if you're able to handle that risk, then you can trade on the higher time frames. But if not, I would just recommend staying on the 10-minute or even the 15-minute or 30-minute. I think 30 minutes good too. Yeah, the 30 minutes all right too. So like you could have taken this right here. This would be a pivot entry because price came up, it came back down, and then put it a buy signal right here. So you could have taken this one and it would have hit TP right there for about 1,000 pips.
All right. So I need to go back and look at the pivots more too.
Yeah, I mean, like every strategy is a little different. There's nothing wrong or right about using, any specific strategy, but it's just really up to you, like what fits you, because all the strategies are kind of similar. So like the same entry that we were talking about right here, this would have been let me see if I move forward. Like you would have just entered this one late. So instead of if you were doing the regular momentum, the one that we were just talking about, the pullback strategy, you
Mm.
would have entered right here for a buy. And I'll just go back and redo it again. So pretty much, just looking back at that same strategy that you were looking at. So first you want to identify the trend. Price is trending up, and then you identify a valid opposite K2 signal. So since this signal is a sell signal, but it's going against the trend, like I mentioned earlier, this would be considered like a little pullback. So it's like pushing up, pulls back, shoots back up. And then again, right here, it's just pulling back temporarily. So once you have those two, you can enter on the high of this candle because we're going to enter a buy. So that's the difference. If you're entering a sell, it would be at the low of the candle. But if you're entering a buy, it'd be on the high of the candle. Do you get what that means?
Yeah, I got you.
Okay, perfect. Yeah, I just want to make sure that we're on the same page. So right here, this would have been the entry if you did a momentum entry. So once you have that set up, you'd put the stop loss at the previous swing, which would be somewhere around here. And then if you
Okay.
let that run, you can see right here that price kind of, so as this candle moved right here, it dropped down a little bit. So you can see this wick right here because price came down slightly. And then once the momentum pulled it back up, it ended up shooting straight up right there. And then at this point, your trade would have been filled because the one that we looked at earlier over here, this one would have never filled. So you would have just canceled your order and then you would have just waited for the next one. So
Okay.
you would have canceled this one and then you would have taken this one instead. And then you can see right here, if you let it play out, it would have hit TP right there for, I guess, 1,700 pips.
All right, cool. Now you said which time frame do you do the scalping off of?
I usually do it on the 10 minute. The 10 minutes usually been pretty good for me overall. So
Could you show me an example of scalping real quick?
yeah, sure, I got you. Let me see. So usually when I scalp, I use the pivot strategy. So I'll just show you right here. Let me pull this back over here. And then, so if you're scalping, you're not going to use the trend meter. You're just going to use the pivots and then the momentum indicator. So let me show you the breakdown for that one. So this is going to be the K2 pivots scalping strategy. So for this one, you're going to identify the trend using K2 pivots to identify a pullback retracement, and then identify a rejection of K2 pivots area, and then lastly, identify a valid K2 signal. And then once you get all those, you can enter on the open of the following candle. And then your stop loss would be, so this would be the K2 pivot scalping strategy. So basically, first you want to identify the trend using the K2 pivots. So when price is above the pivots and the pivots are all angling upwards and they're spread out like they are right here, this would confirm that price is trending up. Because obviously when price is above it and the pivots are all angling that direction, you can see here that it's a clear trend up. Similar
Okay.
when it's below. So right here, price is below the pivots. The pivots are all angling down and they're spread out. So this would be considered a downtrend. So if you want to double check it, you can always just draw your own trend lines, and then you can see right there that obviously price is trending down. And then in the opposite, once price is above it, you can see right here that price is trending up. So once you identify the trend, you want to identify a pullback or retracement. So basically you can see right here, price was trending up. And then once it reached this high point right here, I'll zoom in a little bit. Yeah, once price reached this point right here, so price was trending up, and then it retraced from this point, right? So price came down slightly, and then that would fulfill the second requirement. So once you identify the trend, you've identified a pullback. Next, you need to identify a retracement. A rejection. So price comes up, retraces from this point, and then it rejects right here off the K2 pivots.
Okay.
So right here, we got the first three requirements. We have the uptrend, we have the pullback retracement right here, and then we got the rejection right here. So once you have those three requirements, the last thing you need is a valid K2 signal. So right here, we got a valid buy signal since it's a green buy signal with a green bullish candle. And once you have those set up, you can enter on the open of the following candle. So basically, if you're watching the chart, you're just waiting for this candle to close, like for the countdown to hit 10 minutes. And then once that happens, you can just enter a buy market, or you can enter a pending order. It just depends on how you're looking at it. Because I'm not sure if you're like watching it from, once it closes and opens, or if you're just catching it late. Because some people try to catch it late. They want to give it some time before they enter the trade. Or in some situations, if you're just right there waiting for it, you can just hit market buy. And then as soon as it closes, you're already in the trade.
Okay.
So right here, once you have all that set up, you'll put the stop loss at the previous swing, which would be about 1,100 pips right here. And then you'll put your TP same distance away. So that's pretty much the setup right there for this trade. And we let it play out. And then you can see right here that it's still running. Oh yeah, there we go. So we hit full TP right there.
Oh yeah, okay.
And then
See how that first drop came, that first big drop out there went up? That might have scared me. Sometimes I would have got out of that.
yeah, no, for sure. Like usually I have the TP one, or like I have like one of the TPs on the halfway mark, like somewhere around here. So
Okay.
once it reaches halfway, then I'll just move my stop loss to this point. So like how you mentioned this drop right here, if price got up to that point and it dropped, I would have just cut it out at this point, and then I would have took profits, and then you could have waited for another entry. Because when you're scalping, there's a ton of entries, so you don't have to like be caught up on just one trade, because you can literally get out and then get back in. So this would be an entry right here. This would be the original one. And then if you wanted to go through each one, there's actually another entry right here as well. So same thing, price is trending up from, using the K2 pivots. There's another, let's make it smaller. Price came up right here, and then you can see the pullback right here. So price pulled back right here, and then it rejected off this point, off the K2 pivots. And then we got another buy signal right here. So
and that's a yellow, right? The K2 pivots is a yellow one.
yeah, it would be this one, but it wouldn't need to reject exactly off the pivot. It could literally reject like off any point. Like right here, you can see price comes up, comes down, and rejects off this point. But yellow is usually going to be one of the sweet spots, because this is like the second level of the pivots. Once it pulls back like this far to the farther pivots, then it becomes a little risky, because you can see right here, so price comes down right here, and then it retraces from this point. And once it reaches like this right here, it's kind of iffy, because it's hard to tell if it's going to come back down or if it's going to reverse on you. Because once it gets to this point, there's like one of two things that can happen. It can either continue up, or it can reject back down. So you can see right here that price ends up reversing. So it gets a little more riskier as you get farther, like closer to the farther pivots.
Okay.
Because see, like looking at this right here, this only went up to the yellow pivot. It didn't push up to the orange one. So right here, you can see price, like in the same situation that we just talked about. When you're right here and it rejects off this point, it could do one of two things. It could either continue up, or it could correct back downwards to the trend. So if we looked at that, it ended up coming back down.
Okay, yeah. Okay,
Yeah.
I got you. It never broke that third one, the orange.
Exactly. Yeah, it just gets riskier as it gets closer and closer to the higher pivots. Because at that point, it's kind of like, all right, like once it reaches this last pivot, this is like the last line of defense. It's like either it breaks through it and continues up, or it rejects off and comes back down. So that's why we wait for the signal, because we don't want to just catch the rejections off the pivots. We want to make sure that it rejects off it. And then we want to also confirm that momentum is still pushing down in the direction of the trend.
Okay, I see. I got you.
Yeah, because it's a little different. Like if you look right here, like this would be a risky trade if you were just to take, just take it without waiting for the signal, because right there, you know, a lot of people probably would have thought that, oh, you know, it's probably rejecting off it. But if you just waited for the signal, like right here, you would have been in a better situation. But I think this happened last week. So this was on the 31st. So I think there was news on this day or something. I mean, there's a lot of other factors that come into play that you kind of have to, I wouldn't say it's not super important, but you kind of would want to like know like when's a good time to trade and when's a good time not to trade. Like today with the one that we were talking about, the
Yeah.
US 30 entry from today.
Oh yeah, could you show me that one? Because I did not catch that one.
Yeah, no, we'll go over right here. So basically, the way that that strategy works is that one's actually a lot easier. That's like the one that I do recommend people trade.
What's the
But
name of this?
this is the daily K2 US 30 strategy. So
Oh,
all the US 30 calls that I make in the morning are off this specific strategy. And I'll go over the requirements for this too. So I'll just
thank you, bro.
review this to this point. And for this strategy, we're not using the pivots because what we're doing is we're pretty much just trying to piggyback off the bigger traders. So whenever the traders push the market in a certain direction for that day, we're literally just trying to catch that wave with them. Like we're just trying to ride it up with them, um, instead of like predicting where price is going to be. So basically, 6:30 is when the market opens, and I'll put the requirements up here too. This is going to be the K2 daily US 30 entry. And so first, you're just gonna look for trades after 6:30 a.m. Pacific Daylight Savings Time, and then identify the first valid K2 signal, and then lastly, you can enter on the open of the following candle.
Oh, that does sound easier.
Yeah, it's real simple. Like the only problem is that you gotta be like pretty on top of things like once the market opens, because this entry could come up like at any point.
Like you have to be up and ready at, I would say probably 10 minutes before, just ready watching, right?
Exactly. Yeah. So I usually get up like at 5:20, and then I'm just like I'm up and I'm just getting my charts ready. And then once it hits 6:30, I start to set my alerts. So I got alerts that are set up right here. This is like my US 30 10-minute. So
Mm-hmm.
pretty much whenever this appears, I'll get a alert. So it's like, all right, go check the charts because it's about to, you know, this candle's about to close. Um, but this is a lot easier because you don't have, there's really no confusion. All you're really doing is you're waiting for the market to open, and then you're just waiting for the first momentum signal to basically
Yeah.
tell you the
All
direction of
right. Wait,
price for that day.
that is a lot easier. Okay, I'm gonna do that tomorrow.
Yeah, and this works during London too. So I don't use it during London because I'm usually asleep at that time. But if you're awake, it works the same way. So this is for the U.S. session at 6:30, but for the London session, the market opens at midnight. So it's the
Mid-
same exact strategy. You pretty much just wait for the market to open at midnight,
And
and then
that's at your time, so that'd be 3 a.m. my time, right?
yeah, so you're probably not going to
Eastern.
be up at that point.
Oh no, bro, I'm always up, bro. Like when I know, because I was looking at my little training thing that said the time it starts at 3, so it's like I might be up at 12, and then if I'm up at 12, I'm not going to sleep just so I can be up at 3.
Yeah, no, for sure. But yeah, if that's the case, then you could take this trade too, because I know some people took this trade last night. It's pretty much the same strategy, but instead of here, I'll just change right here. So it's after 12 a.m. London or 6:30 a.m. New York. So it just depends on what session you want to trade. But the strategy works the same way for each session. So pretty much right here for London, you're just looking for trades after 12 a.m. midnight, which is my time, because that's when the London market opens. So the market opened right here at midnight. And once the market opened, you're pretty much doing the same thing. You're just waiting for the first valid K2 signal. And right here, we got the valid sell signal since it's a red sell signal with a red bearish candle. So once you have this set up, you can enter on the open of the falling candle. So you enter a short position right here. And then I found the sweet spot to be 1500 pips. I think that's usually the best range for this specific strategy because
Okay.
I like all my like I back tested this strategy like 2-3 years, and then I figured that normally during each session, so this is during the London session, the US session, price usually moves about 1500 pips before it reaches this point, and then once it reaches this point, it could either continue down or it'll probably reverse. and correcting the other direction. So right here, if you took this trade right here for London, and then you let it run, it would have hit CP right there. So it went straight down. Like I mentioned earlier, what we're doing here is we're just trying to catch this momentum move. Because generally, once the market opens, the big banks and institutions, they usually choose a direction for price for that day. So what we're doing is we're just piggybacking off the ride. Like we're waiting for them to push the price, and then once they show what direction they're trading in, we're just pretty much just riding that wave with them, and then we jump off the ship like once we make a profit, because you never know when it's gonna end up reversing on you.
So you just ride it in the direction that it's going until it reverses.
Yeah, exactly. So the thing is, you could have your TP here, but for some people, they don't even put a TP. Like, usually as it moves down, they just move their stop loss. Yeah, they just move their stop loss with it. So as they just trail it. So once price drops like this, they just move their stop loss to like right there, and then as it keeps moving, they just keep sliding it down, and you can literally ride it like as far as you want.
I'm definitely try this tonight.
Yeah, it works pretty well. And in the same situation right here. So this was a London session. And then like once this is all done, we're done for that session pretty much. We're just waiting for the New York session. So this is London, this is New York. And then once we get to the New York session right here, we do the same exact thing. So it's hit 6:30 a.m. This is when the stock market opens. And then what we're doing is we're just waiting for the institutions and the banks to push price. So once they push price and we get that signal, then we just do the same thing we did over here. We just piggyback the ride. So right here, we wouldn't have taken this sell, even though it would have been a good sell, because it's not a valid signal. Like you don't want to take a signal that's not 100%. It's just too risky, especially during like FOMC today. And I think they're talking like this whole week. So I'm going to be a little careful. But same thing right here. So once the market opens, you're just waiting for the first valid signal. So we don't have one yet during this whole time. And we're just pretty much just waiting patiently. So right here, you can see that there's a signal that keeps appearing and disappearing.
Keep flashing.
Yeah, it's like flashing. Because sometimes what happens is, the banks and institutions are trying to push price in one direction, but then the other bank's like, no, we're not going to let them push it up. We got to push it back down because not everyone's trading the same direction. So right here, and then at this situation right here, this is when you got the actual signal.
Okay.
So same situation over here. We waited for the market to open, waited for the first valid signal, and then once we have this valid signal right here, we just enter a long position right there. And then same thing, you put your stop loss at 150 or 1500 if you're doing the normal lot sizes. And then you pretty much just let it run. So like right here, it got really close to the, so you got like super close to the stop loss right here. So
yeah.
This is why your stop loss has to be on point, because the thing is, a lot of these, the banks and institutions, they know that people have their stop loss right here because a lot of people put their stop loss at the previous swing, which would have been right here. So if you put your stop loss at the previous swing instead of using 1500, like I was mentioning earlier, you would have gone stopped out right here because this is where the swing is. So a lot of people got fucked right here because they put their stop loss at the swing, so they came down, stopped them out, and then as soon as it stopped people out, it shot straight up like that.
Oh, okay.
So you can't be like, this is what I always tell people, like not to trade like how everyone else is trading, because if you're trading,
important.
exactly, because see this little like gap right here would have been the difference between losing this trade and winning this trade, because
That's happened.
It's happened to you before.
Yeah, because I was like, when I was following a trade, I was moving my own stop loss at that point, and I was trying to gauge where to put it, and it literally went right below it and then shot back up.
Yeah, that happens all the time. That's why I usually like to put it a little bit below, because the thing is, a lot of people put their stop losses in the same place, and the thing is, these banks and institutions, they know exactly where stop losses are, because they pay these brokers to like give them the heads up basically. So they know where everyone's putting their stop loss, and that's what happened here. So a lot of people would have gone stopped out, and then as soon as they got stopped out, it shot straight to profit.
Okay, I'm definitely gonna try this. And this is the US 30 daily strategy for London, New York session.
Yeah, and it's real simple. Like this is where I make most of my profit now. Like I still make profit off trading Forex, but like one US 30 win will cover like a handful of Forex wins, because you could be holding a forex trade for a couple of days and it might not even hit. But if you're, if you're just trading US 30 once a day, it's super simple. Like right here, you would have made like, even with the smallest lot size, like a 0.01 on Hugo's way, you would have locked in like 150 off this trade, and then again 150 off this trade. So if you took, the 12 a.m. trade over here, and then you took the New York one, that's like 300 for just two trades on the smallest lot size. And then, as you get better and better, you just keep increasing your lot size and you just keep compounding those profits pretty much.
All right, got you. I'm definitely gonna try this because this looks a lot easier. I like the other ones too.
Yeah, the other ones are cool. It just takes a little bit more work to do the other ones. You got to like actually be on top of it. For this, it's kind of like you just wait for it, and then you just wait for the opportunity. Once you get the opportunity, you hop in the trade.
What's your favorite strategy to use for the pairs?
Oh, for the forex pairs.
Yeah.
So for the forex pairs, I usually use the zone trading strategy and then the pivot strategy. So those are the two main ones that I've been using.
All right. And is the zone strategy that's in the lessons as well?
Yeah, so I'll show you how the zone strategy works. Let me just pull up a different, like some random pair here. Actually, no, I'm gonna open another chart. Yeah, so is there a forex pair that you like to trade? I can like look that up if.
Actually, no. I just kind of go with all the signals you guys use and kind of try to find a favorite one. And ironically, I kind of like US 30, even though it's one I could lose the most money on.
Yeah, US 30 is addictive, man, because you can make a lot of money, but you could also lose a lot of money, depending if you're doing it properly or not.
I kind of like faster moves, so it's like I can't really forget about it because I know it's moving and I know it's moving fast.
Exactly. No, I feel you. Yeah, that's why I like it too, because since I have this daily strategy, usually we'll know if we win or not within the first couple hours. Like we don't have to hang on to it and just watch it like, for days without even knowing if it's going to actually hit or not. That's what I like about the daily strategies because, we enter this trade right here, and then we would have known if we would have won or lost within like 2 hours instead of holding on to it for like 4 or 10 hours throughout the entire day. And it kind of takes out the guesswork because you're literally just looking for one thing. Like once time hits, you're just going to wait for that signal, and then once you see that signal, you can take the trade, and then that's pretty much it for the day.
Okay.
Yeah, but let's pull up US 30. I mean your USD. So I'm going to show you the way that this works. So basically the first thing I do is I go and I mark up the zones. So let me mark this up real quick.
For that second zone, what made you connect those three lines instead of just two of them?
This one right here.
Oh no, up top, like the second, yeah, that one.
Oh, this one right here. Okay, cool. So
Yeah.
the reason I connect these two right here is because I usually want some distance between the zones. So if it's not more than 20 pips, I usually just connect them into like one big zone because
Okay.
yeah, because right here it's only about a 15 pip move. So the thing is, if price cuts into this little zone right here, I'm not going to enter a trade because it's only going to give me enough cushion to like catch like like 10 pips because the spread's like 2 to 5 pips for your USD. So if you're gonna enter this trade, you're gonna be in the negative 5 pips already. So you're technically at loss at this point. And then when you want to exit the trade, you got to pay the spread that way too. So in order to make any money off this trade, you like literally have to be in and out super quick because so if you enter to sell right here, if price comes down, odds are this is a risky trade because once it reaches that next zone, it could either reject off or continue downwards. So like for me, it's like I don't want to take any risky trades. Like I want to stick with trades that I think are almost for sure going to hit. So basically, like right here, these zones are kind of spread out. Like this is like 28 pips, and then there's another space right here. But if the SRs are too close, I usually just connect them together. Kind of similar to right here, like even this middle zone right here, there's only about like a 13 pip difference. So instead of me risking trading within the zone, I'm just gonna avoid it once it's in here, and I'm gonna trade it once it gets outside of it.
Okay.
So that's pretty much that right there. And then I create another zone right here. But it's kind of subjective. Like there's never going to be like one perfect way to draw your zones. It just really depends on how you see it. Because the more and more you practice this, you're going to find a style that you like. You either want to have big zones or you want to have very small zones so you can trade within them. But it just really depends on how you want to do it personally. But yeah, so right here, we got all these zones lined up. And the way that the strategy works is, let me just type this up right here. This is the K² zone trading strategy. And so for this, first you're going to identify direction momentum using the K² momentum indicator. And then last, you just want to confirm a break past K² zone. Break and close past K² zone. And then after that, you can enter, open up the following candle. So basically, the way that this works, first you can identify the direction of momentum. So if we turn on the momentum indicator, you can see right here that generally once price reaches, one of the zones, it usually bounces off. So pretty much, if you just look at the zones right here, you can see that price pretty much it respects these zones like pretty nice. So price comes up, rejects off this zone, comes down, rejects off to this zone, and it just pretty much bounces from each zone. So what we're trying to do here is we're just trying to catch it as it bounces from zone to zone. So if price was to bounce off this zone, we want to ride that momentum to the next zone. And then if it bounces off this zone, we want to take that momentum to the next zone. Because you can see it's pretty simple. Like if you're trading on the higher time frames, it respects these zones pretty nice. So right here, you want to identify the direction. So, obviously if you're going to be trading, you want to trade with momentum because you're just pretty much, it's like with every other strategy that we apply, we're just piggybacking these rides. Like we're not trying to predict, where price is going to go. We're literally just trying to catch it as it's moving. And then we just ride that wave until the wave ends pretty much. So like this is going to be a little harder to look for an entry on your USD because I think the space here is, there's not really enough space for us to really take these entries. Because I think the market was a little off last week. We didn't even take that many trades last week. I think we only took like 4 or 5 trades. Let's see, 20. Actually, all right, so this would be a good entry right here. So let me just go back over here. All right, cool. So right here, you want to identify the direction of momentum. So right here, obviously price is swinging upwards because we got a buy signal right here. So once we have this right here, you want to just confirm that price breaks and closes past the K² zone. So here price came down, it came up, and then it broke this zone right here, right? So once it's broken the zone and it's closed outside, odds are price is probably going to come up and test this zone, or it could even shoot up even further and test this zone, or even this zone up here. Because like I mentioned, like price pretty much goes from zone to zone. So it comes up here, tests this zone, comes down, tests this zone right here, comes up, tests this zone, comes down, tests this zone, and same difference. So as price comes up right here, it could either test this zone and come back down, or it could continue back up.
And is that where you take profit 1, 2, and 3 from on that one? If it hits that zone and then the next zone?
Yeah, usually that's usually where I want to put it. So right here, once you have this setup right here, because first you've identified the momentum. So you know that price is going up. Next, you confirm the break and close past the K² zone. So once it broke this zone right here, odds are it's going to keep on pushing up. So once we have this right here, you can set up your trade with a long position right here. We'll put our stop loss at the previous swing, which is like right here, 68 pips. And then I'll usually put like a TP1 like at the next zone. So like right here, this is where it gets risky, where it gets to this point. So I'll probably put like my TP1 somewhere around here so that if price comes up, we just move our stop loss to this point. So if it ends up hitting that TP, or like once it hits this zone right here, it might come back down. So if that happens, you get stopped out in profit right there for like about 34 pips, which is like half the profit. or you could let it run. It's really up to you. You know, the exit strategy is just, it's optional. It's not really required. But me personally, if you start trading a bigger account, your main focus goes from making a lot of profit quick to eliminating your risk. Because, you know, if you're able to lock in these half profits like back and back and back, and you don't take any losses, then, you know, you're just going to keep stacking those profits. But it's a little different if you're trading a smaller account, because, you know, obviously you want to grow that account. So instead of you wanting to, you know, cut your losses or, you know, cut profits right here, you might want to go for that full move. So it just really depends on how you want to trade it. But yeah, so pretty much I'd put my TP1 somewhere around here, maybe TP2 somewhere around here. And then obviously the full TP would be up there, because like I mentioned earlier, when price moves up, it could either test the zone right here and reject off it, or it could continue on further and test this zone right here, or it could even push even further than that. You kind of just have to think of the different scenarios, like, of what could happen, and that's where you want to put your stop loss or move your TPs, so that you can you know, take the money off the table when you're in profit. But
yeah, I think is little gains. Just don't be greedy.
exactly, that's the whole key. And that's why I run 2 positions. So generally, when if I was to enter this trade right here, what I do is I would have one position that runs to full TP, and then I have a second position where I move my stop loss. Once it reaches this point, I move my stop loss right here, and if I get stopped out, I get stopped out. It's cool. Or if it pushes up further, if I get stopped out up here, that's cool too, because I'm only missing out on a few pips right here. But yeah, pretty much right here, if we let this run right here, you can see that price ends up pushing up right here, and then this crazy spike. I think this happened like last week, where this crazy spike shot up, but it would have ended up hitting full TP right there. I think it spiked up so fast that we wouldn't even be able to move our stop loss, because this thing came out of nowhere. So it was right here. It was like a negative for a cool minute, and then it just randomly shot up to full TP right there. But it would have never hit a stop loss, because it only pushed down at this point.
All right, man. That's some good information. A lot of stuff is a lot more clear now.
Yeah, no, definitely. I know it's a little confusing, like if you're just watching the videos and you're trying to learn on your own, but, you know, if you ever have any questions, feel free to let me know, because I know it makes a lot more sense when I actually break it down for you, like real time, so you can see what I'm doing on the screen.
Yeah. And I had honestly didn't even get to the US 30 strategy and the lessons. So I gotta make sure I just go back and study that every day, just so I can sear that into my brain.
Oh, you never got to it? Yeah, that's like the main strategy that everyone uses, because that one's it's super accurate. Like, I think, let me see, I think we got our results here from
I got a bad habit of, once I think I got something enough, I'll kind of like stop studying until I hit a speed bump. Like, oh shit, I need to study some more.
exactly. And that's the key. You kind of just gotta, like, I provide all these different strategies, but in reality, you should probably just find one that you really like, and then just master that one, because all the strategies are pretty much the same thing. They just provide for, you know, different entries and stuff like that. So let me see. So yeah, these were all the US 30 entries using that same strategy I just showed you. You know, with the daily.
Yeah.
And this, so pretty much right here, we got about how many trades?
So you said you could do the daily US 30 strategy with the regular pairs as well?
No, so that only works for the US 30, because for that specific strategy, we're just trying to catch these, you know, momentum moves like once the market opens. The thing with Forex is that the currency market is open, you know, all day, so it moves a little differently. Like for US 30, these are just stocks that are compiled together, like the 30 biggest stocks in the US. And when the market opens, there's always going to be like some fast movement. There's going to be a movement in some direction. But the thing with currencies is that they don't always move directional. Or if they do move directional, they usually bounce back and forth. Like right here, you can see it comes up and it comes down. It literally just ranges for like days, and it just keeps going back and forth. It's not like with US 30 where you can pinpoint when it's going to move. Like, you know, when it's going to move, you know, once the market opens. But if you're trading, you know, normal Forex pairs, you never really know when it's going to be moving like crazy. The only time it moves crazy is when there's news. And during those times, we usually don't try to trade, because you never really know what direction it's going to move in.
Okay, I got you.
Yeah,
So
because
for it.
They're a little different. They're the assets. So if you're trading indices, they usually move directional. Like if you look at US 30 here, it usually just moves in a direction. But if you're trading, you know, a forex pair, they usually bounce back and forth. They're not
Okay.
really, they're not always just going in one direction, unless there's something going on in the world that's like pushing price in that way.
Gotcha. And you normally and normally for indices, like 10 minutes, and then the forex pairs 4 hours.
Yeah, that's how I trade it, because the indices, I usually just try to catch the, you know, the smaller moves within the day. So the 10 minutes cool because the stock market's only open like half the day. It's open for like 8 hours versus the the currency market, which is open 24 hours.
Okay,
So
I got it. Why now? Okay,
yeah,
perfect.
yeah, because they just move a little differently. Like once you understand how each asset moves, then you can kind of pinpoint how to strategize how you're going to trade those specific pairs.
Relied on the U.S. Postal Service.
Gotcha.
Yeah, was there anything else you wanted to go over? We can go over like anything else if there's any strategies you want to cover, or I mean, if you just want to practice more and we can get on another call at another point, we can do that too.
Yeah, I'm gonna go ahead and take this and go dive into the US 30 daily strategy and look at the pivot some more and make sure I'm brush up on those, and then I'm sure I have some more questions for you, bro. I appreciate you getting me straight with this because I'm gonna try this tonight.
Yeah, I think you like this the most because this is like super easy and it's accurate. But yeah, like once you get this down, you can use this as like your foundation. Like this is pretty much what you make your profit with, and then you can always like bounce it into other strategies and see what else you like there too. Because I think this would be good, and the pivots would be good too. Those are probably the two main things that you should use if you want to trade indices. And then if you want to trade forex, you can always play around with it and see what you like most. But
Okay.
they all kind of line up together.
All right. Thank you, bro. Appreciate you, man.
Yeah, bro, no problem.
All right. Be safe out there, bro.
All right, man. You too. I'll talk to you later.
All right. Bye, bro.